Hi everyone, a very good afternoon to all of you present here. I'm Nitisha Jain, tax expert associated with Clear, and my area of expertise is income tax. Today, we all are here to know about the topic the seven best tax saving ideas, which you should keep in mind and use it to invest your money accordingly, and it will help you to reduce your taxes to a great extent. So, before starting our session, I would like to welcome you all that you all have joined post lunch. I'll try to make this session very interactive one. Post down all your queries in the chat box, whatever you are having. My colleague Saikat is there to answer all your questions in the chat box. And once I am done with the presentation part, I'll also be taking up few questions at the end. Without any further delay, let's move towards our today's agenda. So, we are going to discuss first of all about the budget highlights. What are its key takeaways, which we can take from Budget 2022? Then, how you can claim your HRA even if you are paying rent to your parents. We'll be discussing on that topic. Then, gifting to a family member, best tax saving instruments. So, in that, we'll be talking about the ELSs. Then our next topic will be all the ATC, Section ATC investment schemes which we invest into. Then apart from ATC, our Chapter 60 deductions also, there are lot many investments or lot many deductions which you can avail. We'll be discussing on that topic. Then NPS will be discussing about. Then at last we'll be discussing on what are the smart hacks which you can avail and increase your take home salary. So the topics are very interesting one. I request you to participate in this session and make it an interactive one. So let's move towards our first topic. What are the major key changes which were announced in this budget 2022? So while there has neither been any kind of revision in the tax rates nor any new deductions or exemptions has been proposed, the budget proposal seek to provide clarity in many aspects such as taxation of digital assets or rationalization of surcharge on long-term gains like this. So, on 1st February, our union budget was passed by our Finance Minister Srimati Nirmala Sitharamanji. While presenting the direct taxes proposal, she thanked all the taxpayers of the country who have contributed immensely and strengthened the hands of the government in helping their fellow citizen in the hour of need. So, amongst the direct tax proposal, first proposal which was passed was filing of the updated tax return. So, in order to provide an opportunity to some of the taxpayers who may realize that they have committed omissions or mistake in correctly estimating their income for tax payments, a new section has been introduced to enable such taxpayers for the tax payment. In this, this opportunity shall be available for a period of 3 years from the end of the relevant financial year, subject to fulfillment of certain conditions. It will also help in minimizing the litigations of the income tax department. The corrected in this return, as stated above, could only be filed with the payment of additional taxes, which are 25% or 50% for the return filed within 2 years or 3 years from the end of financial year. So, though the changes will give you an opportunity to correct your errors or omissions, on the other side, it will also be a revenue enhancement measure for the department. It should have also allowed to the taxpayers additional allowances or credit for the taxes, which may have been discovered subsequently, but it is not the case. If you are filing the updated return, then you'll have to pay additional taxes only. You cannot claim any kind of disallowances or any kind of expenditures later on. You'll just have to pay the additional taxes and then only you can update your return. Then, in this series, another proposal which was passed was about the taxation of virtual digital assets. So, with the phenomenal increase in the transactions in digital assets, it has been proposed to tax the tax income from virtual digital asset at a flat rate of 30% without providing any kind of other deductions except the cost of acquisition of such asset. So, if any loss you are incurring from the transfer of digital asset, that also you cannot get any kind of set off from any other income. Also, the gift. of the digital asset is proposed to be taxed in the hands of recipient only. Further, in order to capture the transaction details, TDS provision is also being implied on this. So, if you are having any kind of gains from transfer of digital assets like cryptocurrencies, and that wholly will be taxed at rate of 30% without any set off of any cost, allowances or losses. And it is also not clear that if loss from the sale of digital asset will be allowed to be set off from the gain on sale of digital asset. This change seems to equate the gains on digital assets to gambling income and overlook the fact that it should have been taxed as normal income under the head of income from capital gains or from income from business or profession. Moreover, the now the world is moving towards cryptocurrencies, and the proposal of the finance minister seems to discourage the investing in cryptocurrencies. Along with that, the TDS provision at the rate 1% by the buyer has also been imposed on it. So this change proposed seems to overlook a practical difficulty, especially wherein the trading is done through digital platform or where the buyers are outside India. But this amendment has been proposed. Now it will be coming into the tax bracket. Talking about our next proposal, it was about the tax relief to the differently abled person. So, as per the current tax laws, the deduction is available to the parent or guardian of the differently abled person for an insurance scheme taken for such person. However, the deduction is available only if the lump sum payment or say annuity payment is available on the death of the parent or guardian. The budget has proposed to extend the deduction for such scheme even when the payment of lump sum or annuity is provided to the differently abled person during the lifetime of the parent or guardian, even after they are attaining the age of 60 years. Apart from this, the rationalization of surcharge on long-term capital gain. What they did in this was, as per the current tax laws, there was difference in the rates of surcharge arising on the long-term capital gains. So the long-term capital gain on listed equity shares, units, etc., are liable to a maximum surcharge of 15%, while the other long-term capital gains are subjected to a graded surcharge which goes up to 37%. In order to address this equality or this difference, it has been proposed that now the surcharge on all the long-term capital gain will be capped at 15%. The distinction between this listed and unlisted shares has been removed, along with bringing all the long-term capital assets within this purview. This change is a welcome one, as it would increase the disposable income in the hands of taxpayers by a sizable amount. Then they had also reduced the alternate minimum tax rates and surcharge for the cooperatives and AOPs. In order to reduce the litigation, new scheme for management of litigation has also been proposed, wherein the superior authorities could instruct the tax officers to keep on hold the filing of appeals before the tribunal and the High Court on similar question of law pending before the High Court or Supreme Court in case of any taxpayers. So this would significantly reduce the filing of frivolous and repetitive appeals. So this was about all the litigation thing also. And when talking about the COVID related budget proposal, one thing was passed by our finance minister in that it was proposed that if the payment is received from employer by the employee or his survivors or from any other person, if it is up to the aggregate limit of rupees 10 lakh for the treatment of COVID-19, it has been exempted from tax. This is expected to give a significant relief to the taxpayers who have already gone through pain, especially during the second wave of COVID-19. So, this is a good proposal which was passed. Then, at last, she also told that the TDS provisions for the benefits or perquisites paid to the business or professions. So it has been proposed in that if any person is responsible for providing any benefit or perquisites to a resident arising from business or profession carried out by such resident, then it shall deduct tax at the rate of 10% on the value of such benefit if it is exceeding rupees 20,000. Apart from this, there are now health and education cess are also not allowed as business expenditure. So this was all about the business and all about the amendments which were passed in this budget 2022. Now, moving on to our next topic, if we talk about the salary structure. So, what we understand about this term is that it is the very important information which determines the in hand pay, gross salary, net salary, allowances, etc. So, all these variables are paid to the employee as part of his or her compensation and benefits. If an employee does not have details of the components which he or she cannot calculate, then the in hand as well as the saving part like employee provident fund. So the salary structure can prove to be very critical for any employees as it helps them to better manage and understand the salary. Then talking about the income tax thing, what we understand about income tax is it is the one's personal income on which tax has been levied. The process on which tax has been deducted will be called as tax deducted resource. So when your employer is providing you the salary component, before providing you the salary, they'll deduct some amount which will be called as TDS. And if you have any kind of investments also, then you have to declare all the investments during the year which you have made to your employer so that they can include that amount in your form 16. And after including your investments and everything, your TDS will be reduced less. Now, how you can calculate the taxable income on a salary? So, for that, it will be essential to gather all the details which is required to file your income tax return before computing your taxable income on the salary. You will then have to calculate your total taxable income, followed by the calculations of the final tax refundable or payable. To calculate this final tax, you will have to use the applicable tax rates before subtracting taxes already paid through the advanced taxes or TCS or TDS from the tax amount due. So, following for the calculations on of taxable income. First thing which you have to do is you have to gather your salary slips along with your form 16 for the current financial year, and in that you will have from that form 16, in that form 16 you will see from your basic salary all the reimbursement which you have got like HRA, then LTA, any kind of gratuity payment if you're having, all those will be reduced. Along with that, the standard deduction and professional taxes will also be reduced from your salary income. So the net amount will be called as net salary income. From that, you will on that net taxable income, you will have to pay the taxes. So now we know this thing also that from last year, two income regimes were proposed: old tax regime versus new tax regime. So if an individual decides to file his or her taxes according to the new income tax regime, following things you will have to keep in mind. First of all, there are no exemptions under the new tax regime. Second thing, there are no deductions as well under the new tax regime. The calculation of the taxable income as per the new tax regime will be very straightforward, and it will be calculated as direct percentage of the income which is earned by you. So in the new regime, tax rates will be lower. That's fine, but you'll have to keep this thing in mind that you are not going to get any kind of exemptions from your salary or any kind of deductions under Section 80C. So if you are not having that, then you can go with the new tax regime. Accordingly, you can make the decision. And we have income tax clear tax calculator also on Google. When you will open that link, you will see for a table. So in that first thing you will have to enter all your income details, income from salary, what exemption from salary you are getting, if you are having any kind of interest income, that you will have to enter. Then in the next point you'll have to enter all the deductions whatever you are availing. Say for example in ATC you have invested rupees 1.5 lakh, that thing you will have to enter. After entering all the investments, in the fourth point, at the last, you will see a comparison table between the old and new tax regime. And you can see yourself that what amount of tax you'll have to pay at the year end in the old regime and in the new regime. So, accordingly, seeing that table, you can make your decision that which regime is useful for you, what you can opt for. So, now moving on to our next topic. You can claim HRA even by paying rent to your parents. So, yes, you heard me right. Am I audible properly? I can see some comments. Yeah, fine. Talking about HRA thing, house rent allowances and income tax, it means the component of the salary which is received towards the rent payment and is allowed as deduction. So some people have this doubt that whatever rent amount which I am paying can can I claim it as whole the entire rent amount? Can I claim it as the HRA exemption? So answer to that question is no. You cannot claim the entire rent amount which you are paying. As per the income tax law, there are three conditions to claim the HRA exemption. First one is actual HRA, which is received by the employee. Second one will be the 40% of salary for non-metro city or 50% of the salary if the rented property is situated in metro cities like Mumbai, Delhi, Kolkata and Chennai. And the third condition will be actual rent paid less 10% of the salary. So from this calculation, whatever will be the least amount from these three conditions will be allowed as your HRA exemption. um, some if you are staying with your parents or then also you can claim the HRA amount if you are paying rent to them. In that case, if you are unsure that how you can claim if you are living with your parents, so in that case, what you'll have to do is your parents have to show this rent income in their income tax return as the rental income, and you can not you can just after that you can just show that income under your income from salary as the exemption part. So if you have submitted the rent receipts to our employer, then in that case they will calculate the HRA exemption amount and they will include it in your form 16. But in case if you have forgotten to submit your rent receipts to your employer, then also at the year end, whenever you will file your income tax return, at that time also you can calculate your HRA exemption correctly by using the HRA calculator. If you are having a doubt how you have to calculate, so there is no need to manually calculate it. There is clear tax HRA calculator. Saikata will provide the link in the chat box. So using that calculator, you can calculate it yourself and include the correct amount in the income tax return. So, if your house is owned by your parents, then only they can include that rental income in their income tax return. But if the house is in your name, then you cannot claim HRA exemption because you'll not pay rent on the property which is on your name. So you'll have to provide all the rent receipts and agreement which you are having. You'll have to provide the rent receipts and you can claim the HRA exemption accordingly. So talking about the HRA thing, this was all about HRA. Then our next topic, which is gifting to your family members. So, as we live in India, which have lots of reason to celebrate owing to its diversified cultures, customs, and religion, there are numerous occasions which arise where gifts are exchanged. Many a times, gifts can also be part of tax planning or tax evasion. While tax planning is done within the framework of law, it is permissible. Tax evasion is prohibited and it can be penalized. But little did you know that these gifts are also taxable after a certain limit, and one needs to pay income taxes on the gift which are received by them. So, as per the law, gifts which are received by any person or person are taxed in the hands of the recipient under the head income from other sources at normal taxes. So, if an individual is receiving gift from any of his relative, will not be taxable for a donee. Here, donee means the recipient of the gift, but income from such gifts may be taxable in some cases. Say, for example, deemed donor concept, in-house property, or say clubbing provisions, etc. So, you can give an amount up to rupees 50,000 to a family member without it being taxed, but if any person is gifting any amount to an individual on occasion of marriage of that person, or if any person is gifting to under the will or by way of inheritance, then there will be no tax provisions on this. So, due to this, there is excessive tax planning in India using gifts, which apparently fall under the scrutiny of the department if they are in huge quantity. So, therefore, it is important to maintain the documents to establish the genuineness of the gift which you are giving. So, you can avoid the gift taxes by knowing more about it. But the best way to avoid gift tax will be if you are giving it in form of cash. If it should not be aggregating more than rupees 50,000, you'll have to pay taxes on the monetary gifted by you. So as the receiver will bear the less taxes. If you want to gift the amount, then remember this, that if it is up to 50,000, then no tax will be levied on that. If it is above that, then you will have to pay taxes on that. Then our next topic is about why you have to save taxes, how you can save it via ELSs. So with such a long list of options, choosing the right investment scheme, it is the tough task how you can choose the right investment scheme, how you can make the proper investment. So the aim of any tax saving investment is not only to lower the tax payable, but also to save for the future and create the corpus for emergency funds, right? So now you could only invest in traditional ATC approved investments like LIC and PPF and may do with that. But if you want to grow your wealth, you have to invest in a tool that promises you the higher returns for the long term. ELSS funds have been the most preferred option in recent years for the following reasons. First one will be that ELSS provides a tax deduction up to rupees 1,50,000 under Section 80C. Then second, these funds also provide the triple E benefit. First is tax exemption, wealth accumulation, and zero exit load. And the third benefit in this will be that these funds invest primarily in the equity market in a diversified manner, which gives investor a good opportunity to earn the inflation being returns. So, of all the investment options which are available under ADC, ELSS offers the lowest lock-in period of only 3 years. Also, these funds do not have a limit on the investable amount. So, once the lock-in is completed, investor can choose to liquidate the investment or stay invested based on the fund performance. So, here is a quick glimpse that how ELSS compares with the other commonly used tax investments. What you should know about the ELSS before you invest in this, that first you may invest any amount which you want to in ELSS, but you should keep this thing in mind that the deduction part will be capped up to 1.5 lakh only and not over that. And it is one of the best investment options that offer the tax benefit with potentially higher returns and short lock-in period. In this, the returns on ELSS will be tax exempt, whether it is dividend income or say capital appreciation. You can continue to invest in this scheme even after the completion of the lock-in period of 3 years. So the risk involved in this ELSS will be higher when compared to fixed deposits or PPF, but the returns are potentially higher as well. Now we'll see about the other ATC options also which are available. So in that, if I talk about the LIC plan, so every income taxpayer should have a life insurance policy, not just for the tax exemption, but for also securing his or her family's future in their absence. So LIC of this LIC premium will offer a tax benefit up to rupees 1.5 lakh under ATC. Also, in case of death of the insured, the lump sum amount offered to the beneficiary as the death is not taxable. So, if you are taking LIC premium policy, then you can include this amount under ATC section. If you have taken any kind of ULIP plans, so if you are looking for long-term investments, then ULIP is a good tax saving instrument. It offers the insurance to your investment. Your premium is invested in the debt and equity market, offering you the tax-free returns. You can expect some good results from the ULIP only if you invest for 10 to 12 years. ULIP is tax saving investment tools which will allow you to switch between the equity and debt. And if you are investing in PPF, then it is also the most preferred option for the tax benefit under Section ATC. Then, if I talk about more ATC investments, if you are paying your children's tuition fees, then that will also form part of your ATC investment. Sukanya Samriddhi Yojana, these all investments will be part of your ATC deduction, but only the thing will be that maximum deduction available under this section will be capped up to rupees 1.5 lakh only. If I talk about the housing loan components and everything in brief, so home loan must be taken for the purchase or construction of house, and the construction of the house must be completed within 5 years from the end of the financial year in which the loan was taken. So if you are paying the EMI of the housing loan, it will have two components, interest component as well as principal component. The interest portion of the EMI, which is paid for the year, it can be claimed as deduction under Section 24 in the income from house property head up to maximum of rupees 2 lakh. And the principal component will go under Section 80C up to the maximum cap of 1.5 lakh. So, along with the principal repayment, if you are having stamp duty and registration charges also, then in the year in which you have paid this amount, then in that year itself, you can also avail this under ATC section with the principal repayment part. So, the interest component will fall under income from house property head up to rupees 2 lakh, and principal repayment will fall under ATC up to rupees 1.5 lakh. So this was about the ATC investments, what you can invest it into, how you can invest, what are the lock-in periods, and everything. Now, if I go beyond the ATC investment, you will talk about the ATD, under ATD, health insurance premium. If you have taken any medical health insurance for your parent, for your family, spouse, or children, then in that case, if your age is below 60 years, then you are eligible for the tax reduction up to rupees 25,000. And if you have taken any medical insurance for your parents who are senior citizen, then in that case, the maximum deduction which will be available is up to rupees 50,000. Let's suppose if you have not taken any medical insurance policy for your senior citizen parents, but you are incurring medical expenditure on their behalf. So in that case also, you can claim up to rupees 50,000 as the medical expenditure for your senior citizen parents. Only if you are not having medical premium for them. But if you are having medical premium, then altogether you can claim 50,000 only as the deduction. That is the maximum limit. If you have taken the policy of less amount, then that lesser amount will be allowed as your deduction under ATD section. Um, then 80 if you think that okay fine, you have invested the entire amount under section 80C and you have availed the entire limit of 1.5 lakh, you have also claimed this medical insurance premium up to rupees 25,000 under ATD section, you want to invest more, you want to reduce the taxes to more level, then you can also avail ATCCD 1B section, which talks about the national pension scheme. Under this section, if you are concerned about your retirement and are looking forward to plan with your tax saving benefits, then NPS is the best tax saving instrument. It is known for its investor friendly features, low cost structure, and flexibility. Here you can claim any additional self contribution up to rupees 50,000 under ATCCD 1B section. So under ATC you can claim 1,50,000 and under ATCCD 1B you can claim additional 50,000. This limit is over and above the limit of ATC. So altogether from these two sections you can claim up to 2 lakh rupees and reduce your taxes. So it is important for you to continue investing up until the age of 60 years. But if you have been investing for at least 3 years, you may withdraw up to 25% for certain purposes. So as you can see, this is a comparison table. There are not comparison table. These are the two accounts which you can open: Tier 1 account and Tier 2 account. So the Tier 1 account is default. It is mandatory one, while Tier 2 is the voluntary account. Withdrawal from Tier 1 account is not permitted up to the certain limit, and in Tier 2 it is permitted. Tax exemption, as I said, in Tier 1, combining, if we combine two section, ATC and ATCCD 1B, so altogether from these two section, we can claim maximum up to rupees 2 lakh from this, and in Tier 2, 1.5 lakh will be tax exempt for the government employees while none for the others. Minimum NPS contribution under Tier 1 account will be rupees 500 or 500 or rupees 1000 per annum, while in Tier 2 account it will be rupees 250. The maximum contribution under both the accounts, there is no limit for the maximum contribution. You can contribute whatever amount which you want to contribute. So apart from ATC, NPS contribution, there are other medical related deductions also. So we discussed about ATD. Then if you are also treating for handicap dependent, if you have any handicap dependent and you are incurring treatment for that, in that case if the disability is 40% or more but it is less than 80%, then you are going to get flat deduction of rupees 75,000. But if the disability is 80% or more, then deduction of flat rupees 1,25,000 will be available. If you are also incurring the medical expenditure on some specified diseases on self or dependent your dependents, then in that case if age is below 60 years, then the 40,000 or the actual amount paid, whatever the least amount will be allowed as your deduction. And if they are senior citizen which is age above 60 years, then in that case 1 lakh or the actual amount which is paid will be allowed as a tax deduction under section 80 ddb. Now, if you yourself are suffering from any kind of disability, say physical disability, including mental retardation or blindness, then in that case, you are going to get flat deduction of rupees 75,000. But in case of severe disability, the deduction amount will get increased to 1,25,000 flat. There is no that any kind of if you want that, no exemptions or anything. So this was all about the disability section. Now if I talk about the educational loan, if you have taken any kind of educational loan for not only for the studies in India but your foreign studies also, so it can also help you to save your taxes. If you have taken educational loan and you are repaying the same, then the interest part paid on that educational loan will be allowed as a deduction. I repeat, you are going to get the deduction only on the interest component and not on the principal part of the EMI. There is no limit on the maximum amount that is allowed as deduction. It is available for 8 years, starting from the year in which you start repaying the loan or until the interest is fully repaid, whichever is earlier. So it should also be noted that if your loan tenure exceeds 8 years, then you cannot claim a deduction for the interest paid beyond 8 years. So it is always advisable that if you have taken an education loan, then that should be paid within 8 years. This was all about the deduction parts. All the chapter 60 deductions I covered mostly. Then apart from these sections which are mentioned, if you are donating any amount to any kind of charitable organizations on anywhere, then you can claim the donation exemption under section 80G. And also if you are having any bank interest, saving bank interest amount, then up to 10,000 it will be exempt if your age is below 60 years. So this was all about the tax saving instrument. You can avail the maximum which you can avail as per your limit, as per your investment risk which you can take, and make your maximum tax saving things. Now, if I coming on to our next topic, which are the smart tax saving hacks which you can avail to increase your take home salary. So you can first claim as many deductions as possible. As I said, you can claim the HRA component. We discussed HRA in detail in the previous slides. Then, if you are having LTA also, then you can claim that LTA component, and it will be reduced from your income from salary, and it will be help you to reduce the taxes. If you have also claimed any kind of reimbursement, say for example telephone bills or broadband bills, so whosoever are eligible for this, then you will also have to reduce this from your income from salary component. Then EPF contribution is reduced by your employer only from your monthly salary, and EPF is also part of ATC donations deductions. So if you are having housing loan, then as I said, interest component will fall under income from house property head, and the principal component will fall under the ATC component. If you are having all the investments proof with you, then it is better to submit all the investment proof receipts to your employer, so that they will be able to they will be able to evaluate all the investments, and properly they'll include it under the respective sections, and accordingly they'll prepare your form 16 correctly. So at the end, whenever you will file your return, you'll have to just upload your form 16 and your income tax return will be calculated correctly. Then, if you want to calculate the correct HRA thing, or also if you want to uh, calculate that what amount of tax you are eligible to pay, then for that all the calculators, income tax calculator or HRA calculator, rent receipt generator, all these are present, available on Google. You can Google it, and you can avail the maximum benefit which you can avail. So this was all about the today's topics. I hope many things were clear to you. Maximum questions would have been answered by Saikat. I would also be happy to answer your questions now. Devraj, how much tax we can save by house loan? As I said, it is interest amount you can claim it up to maximum 2 lakh rupees, and principal repayment up to 1.5 lakh rupees. Sham, if you are paying rent to your parents and home loan in different city, then yes, you can claim the both. Benefit of HRA and the housing loan can be claimed together. There is no problem in that. Documents which are required to claim home loan benefit will be the loan proof which you'll get from your bank. In that, the interest component and principal component will be reflected separately. So the answer, yes, you can claim HRA as well as housing loan. But all the tax saving benefits being explained here, yes, these tax saving benefits are applicable only for old regime, because as per the new regime, you cannot claim any kind of exemptions or deductions. Even if you are investing into the all the eight, chapter 6A components, but as per the new regime, you will not be able to avail the benefits of that, because it is the law. Loan can be taken if you are constructing house on that, or if you have taken a housing loan only. Gift can be considered under income from other sources head. Housing loan certificate will be required. If you are paying rent and if you have rent receipts, then yes, you can claim. Arush, loan housing loan amount will fall under income from house property head, and HRA exemption will fall under income from salary head. So both the things are will go under the two different heads of will go under two different heads. So you can claim it in both ways. ELS's investment will be tax exempt under ETC. Till the time your housing loan is fully repaid, till that time you can claim. Returns will be taxable only the if you're investing the amount that will be tax exempt, not the returns. If you're having medical premium for your parents, then extra medical expenditure you cannot claim. Donation, if you are donating to the registered charitable organization, then 50% will be allowed as the tax exemption. And for some organizations, say for example, PM COVID Relief Fund, if you have donated to that, then in that case, 100% is also available. Now the home loan benefit has been extended to self-occupied house property, but the maximum interest deduction will be capped up to 2 lakh rupees only. You cannot claim beyond that. No, there is no separate provision for COVID medical expenses. If your employer has deducted some amount of tax, extra tax, if it has been deducted, then you can claim it at the time when you're filing your income tax return. VPF will also fall under ATC component only. I think most of the questions have been answered. If you have further questions, you can write to us at support@cleartax.in. Our support team is there to answer all your questions over there also. We'll be happy to help you. So, thank you so much, everyone, for joining. Have a great day ahead and have a great weekend. Thank you.